Hello, this is Graham Bibby on the 9th of February 2016 with the promised Camtasia, which was going to go out yesterday, but I overlooked. It was Chinese New Year. So anyone listening, Kung Hei Fa Choi, Happy New Year to you in the year of the monkey, the power year 2016. So first of all, we're going to have a look at why we're in cash. I have one stock, McDonald's, and that is tinkering on the point where we might sell, but we are 95% in cash. And I don't know how many other people you know who manage and direct and buy and sell signals for people that have their clients virtually in cash, 100% cash. The whole tradition is you buy and hold. Well, let's see what buy and hold is doing right now. Here's the S&P 500, the top 500 stocks in the US. And this is what it's been doing since November, and the acceleration in the decline over the last 2 weeks has seemed to increase. The market doesn't always do what we think it should do logically. Here's Apple that had record profits recently, and the stock is trading currently at 95, and just a little over 6 months ago the stock was 135, so that has gone down 40 points, which is about 25-30%. Oil, which has been the major worry for everyone, this is the United States Oil Fund, which kind of follows oil. Just in October of 2014, something like 16 months ago, was trading at around $33. It's $8.64. The Nasdaq, as they call it on TV, the tech-heavy Nasdaq. I don't know why they keep calling it that, but they keep liking to say that. It's the Nasdaq. Since the beginning of the year, has been on this free fall, turned over, and is dropping quite sharply. Although yesterday might have seen a key day reversal. Those who follow me a lot will know a key day reversal is when you get to an extreme low and then you reverse in the day. You're still down, but that you can't quite see it. That point here on the right is where the market ended for the day. So although it was extremely down, there's a gap down. It might be that this is the climatic sell-off before we reach a bottom. Now, there's some interesting things going on because the dollar, which has been so strong, hasn't really made any progress for a year, and it might be turning over here. This is a bit of a decline in the dollar. That might be a concern that US interest rates aren't going up anymore. And on the back of that, gold seems to have broken out. Boom! To the upside. Gold and silver are very unloved, as are resources. But a lot of smart money in the world that I can see are buying in for the long term, especially in resources. But this is how bad it's been since 2011. So that's the top there, and it's broken above it. What we'd like to see is a bit of a correction now, and then the market to turn up on increased volume. That would mean that this breakout is real. This moving average is pointing upwards. It's broken through this falling moving average, and if that turns up, it could quite well be that it's time to buy gold, and here's silver, which is following that trend. Copper, interestingly enough, which is sort of regarded somewhat as a bellwether for state of economy sometimes, and building and manufacturing, whatever, has been in an uptrend through this decline in the markets. If we go across to Hong Kong, it's not getting away with anything. This is the Hong Kong ETF, which was 25 last May, and is 17 now. That's 8 points. In my reckoning, that's 30% decline since last May. So even though we've been finding life difficult, moving in and out of the markets, that's the only reason we've accumulated some small losses on that side of it. We're not doing as bad as a lot of these markets. This is the Sydney All Ordinaries Index, which was 6,000 last April-May time, and breached 5,000 in January. It's bounced a little bit, could be a bottom forming, I don't know, but that's 1,000 points. something like 18%, not that bad. Aussie dollar's been weak, so that makes it worse. In Asia, this is Asia ex-Japan. Again, this is a fund. It was 70 last May. It's 48 now, and it's off the bottom. So 48 from 70, in my reckoning, is 22. So it's down about 30%. And then, reason I don't believe in buy and hold, because I've seen a lot of this in people's Australian retirement funds and balanced portfolio, a blue chip called BHP. Well, in July of 2014, the stock was around 75, and recently it went down to 20. That's a 55-point move, which is huge. That's, I don't know, what is that, 60, 70% decline? And if you were holding it, and if you were playing the dividend play, the banks have done the same. So right now, in the Insiders Club, we're not playing the game. Well, we are playing the game, but we're from the sidelines. We're waiting for a bottom. There's some great opportunities coming ahead. We're in cash. My Insider Club special situations clients are taking advantage of some magnificent potential in some stocks and private placements. So Graham Bibby on the 9th, which is one of my favorite numbers, and we're 6 minutes 30 seconds into this, saying have a great Chinese New Year. This is the year 2016, which adds up to 9, which is my power number. I believe at some stage during this year we will make some terrific profits. Our Insiders Club undervalued superior earnings will really come back into form, and even my ETF service, where we're following markets in sectors, will do well. But what's going to knock the ball out of the park over the next few years is special situations. So if you want to know more, or you want to refer me to anyone, please do. And you can contact me at ceo@richmondth.com, or Brenda, who's absolutely fantastic, at paceo@richmondth.com. And if you happen to be in Oz, this is where I am at the moment, meeting with my Insider Club members from 42 degrees Perth at the moment, soon to go to Adelaide, then back to Melbourne, then to the Gold Coast, and then to Sydney. So Graham Bibby for now, over and out.